I'm Lennart Mauritzon, the CFO of the group since 2011. And I think, as Magnus said, I probably have the best CFO job in Sweden, because be able to present financials for this group is great. So, let's start with a slide you have seen, but it's really to reiterate our historical financial performance over the years and showing that we have delivered according to our plans and ambitions on sales and on EBIT. But not just that. Cash flow is of course important, and if we look at our operational cash flow the last 3 years, you see that it has been strong. We have been averaging 86% in cash conversion over EBITDA in average those 3 years. Actually, last year we were above 90% in cash conversion. But good thing to see is also that it's very predictable. As you can see between the years, the quarters look similar, and it also reflects how the business is done today, where we have our lower sales quarters in Q4 and Q1 every year, meaning also that that's the time when we prepare for the higher quarters of sales, Q2 and Q3. So we are building up working capital and those things end of the year, beginning of the year. So really a good pattern that we also can predict and we can plan accordingly. And CapEx, of course, we have our own manufacturing assembly units, and we are stable at 2 to 3% of our turnover in terms of CapEx. So I would say still quite asset light. We are a global company. We are selling in 140 countries. So of course we're exposed to many currencies. So looking at my colleagues, they're sometimes wondering how do we handle all these currencies. But this is the actual 2016 flows in terms of currency for sales and for our EBIT. And as you can see, it's one currency that stands out that is making the big difference driver for the company, and that is euro. So of course, in many of those countries, we sell in euro. We don't have that big cost structure in euro. So therefore, we bring in a lot of money to bottom line in euro. Notable, I think, is to mention the US dollar, which is 1/3 of sales. But look at the EBIT impact, hardly none. And that is because we have a big US operations over there. And many of the products that we are buying, either finished products or components into Europe, for example, is bought in US dollar or in some way pegged to US dollar. So euro is the big one that you should think about when you think about Thule. Working capital. One thing I am very proud of the team, that actually, because during this presentation and those who have followed you, you know that we are not shy to driving changes. We have done a lot of things in order to drive sales, to better serve our customers. And many times that hits back to the back end of your business. There is a supply chain organization with the people, the structure, the systems, processes, whatever, that need to cope with all these changes. And many times you can see quarterly reports and there is some error or fault in the company, blaming distribution setup changes, building a factory that didn't open up in time or whatever. I'm proud to say that with all these changes, in spite of that, we have managed the working capital. Also, the fact that we have started with the new categories entries, which we source more third party, primarily from Asia, there will be longer lead times on the inventory to get it in where we will sell it. So most importantly, we have done all this without influencing the on-time in full performance, which means that we have been able to actually sell. So sales, they can't complain that they didn't have the products. That's good for me. So I can anticipate one question, because most times when I get questions, this is one of the questions, can you do more efficiently on the working capital? Because I know a company, they have 15.7% in relation to sales. And yes, we could. But to be very honest, this is not the priority to drive that one and jeopardize the sales and with the connected good contribution margin in the sales. So by that, weighing risk versus reward. So I think this is something that we should develop, keep eye on. And of course, we don't want it to be higher than it's necessary, but I'm very happy with this. Product is king. I think every presenter has said that today. So that is, of course, that is the DNA of this company. We have mentioned also one of the reasons for our good EBIT improvement has been the economies of scales. So by launching new products, more products, broadening into new categories, we have been able to do that with a quite maintained SG&A structure, where we have the things in place to be able to handle more sales. Then you have a nice fall through to the EBIT line. Except product development, where we actually have allowed and said that this is so strategic important that here we will spend more money. So like in 2010, we spent around 3% of our sales on product development. Since 2012, we have been above 4%. We're actually right now around 5%. And as Magnus mentioned, and I think you should be happy, we are aiming to spend even more. So for the next 12 months, we'll probably be around 6%. Because of the heavy entering into these new exciting categories. But because that has been both, I would say mostly internally, people are afraid of that. If we're going into those categories, what does that mean for sport and cargo carriers, for RV products? But I would say that we are bold to say that, as you have seen, we should push there as well, and we can manage it. So this is more just to have a heads up that, yes, we will continue to spend. It will even be a little more, and then go back to probably slightly more normal levels. But this is exciting. And we have generated a lot of cash, and we are convinced that we will continue to do that. So since the IPO in November 2014, we have brought in more than 2 billion SEK in cash. We have been able and allowed to invest a lot on all these strategic and organic initiatives you have seen. That is the foundation also for going forward to secure the long-term profitable growth that we are saying. In the meantime, during the same time, we have distributed close to 1.4 billion SEK in dividends to our shareholders, split it in the ordinary and the extra that we did this year. That actually, if you would count our accumulated net profit of those years, these dividends is actually more than what we have done as a net profit. So I think that's good for the shareholders. And then we have done 2 divestments of the non-core businesses, the volatile snow chain business, and this year the US toolbox businesses, to really make sure that now we are clean, we are the branded consumer goods company that we want it to be. And added 1 small but strategic acquisitions, like Magnus mentioned. So, of course, now I will leave over to Magnus, and actually next agenda point is M&A. So Magnus, could there be an M&As coming?
Yes, Lennart, they can. It's obvious that if you are ambitious, we are, if you want to grow in new categories, as we intend to do, that M&A is a part of the toolbox, and it should always be. But it is important to remind you, we are not changing guises. We're not lifting one mask and becoming a new management team. We're still going to be, as the main driver, organic growth. But we've always said, tactical, right strategic acquisitions we like. And as I mentioned before, we actually, in a small scale, have very tactically used this. The 2 acquisitions within Active with Kids have been key components for driving that opportunity. So we are continuing to scan the field, and I would say that after having a pretty busy time, as I mentioned before, with the divestments and IPOs, over the last 12 to 18 months, myself and Lennart and the team have had more opportunity to really look into those opportunities. We will be very selective. We're not going to change our approach. There has to be some true upside of what we can do, what we bring in, but we are looking at more, and hopefully we will continue to add a few acquisitions as we go as well. But do not start to think of us as an M&A engine. We will not be, as long as this management in this place. It has to be the right fit. So with that, if we summarize this company, you know, and you can see on us that we're proud. We've delivered a lot of things, but most importantly, we are hungry to deliver more. So if you look at what we do, 75 years is a great year to have, right? It's a 75-year birthday we've celebrated this year. It gives you the chance to say there's been a lot of good things done, we've become global. It also forces you to think about the next 75. We've also delivered to what we promised to the market over the last few years with strong sales growth and even stronger EBIT growth and generating a lot of returns to shareholders. We have overarching market trends that are positive. We have a fantastic brand that we're emotionally loading with more values. So with all of that, and then on top of it, those two large categories, luggage, behemoth category, strollers, very large category, and with some ongoing development work that has already been happening, and playing for the long game, not for next quarter, how much it is for the next 5 to 10 years we have to play for these categories. But if we take those and combine with a true sustainability approach in how we run the business, it was time to raise the EBIT margin targets because we will continue to have economies of scale. We are convinced about that. We are a team who likes to run it lean in terms of back office functions and staff functions. We don't have a lot of those. We're taking in all those right people, you know, the people from Thule, the people from Bugaboo. We're beefing up the team for the new driving revenue generating part of the businesses, but we will not become a big corporate office. And then driving profitable sales growth will deliver EBIT growth as we see it. So with that, hopefully we've sent a message to you that we're competitive and that we're hungry. So thank you for taking the time to join us on this Capital Markets Day. Thank you.